You heard the title right. I'm not speculating, I am connecting dots that were deliberately placed in the shadows, a trail of digital breadcrumbs leading to a financial abyss that will make 2008 look like a minor market correction. The AI financial crash of 2026 isn't a distant probability. It's a chain reaction that has already been initiated, and its primary trigger is hidden in plain sight, embedded within the very technology many believe is securing their financial future. While the world was obsessively watching the daily fluctuations of their crypto portfolios, a silent systemic cancer was metastasizing in the core of our new digital economy. The CEO of Tether, Paulo Ardoino, just let slip a clue so profound and terrifying that 99% of investors scrolled right past it. It wasn't delivered in a dramatic prime-time interview. It was camouflaged within the announcement of a new, seemingly niche product, a quiet, almost philosophical statement that carries the weight of a final warning. He said, and I want you to listen to these words very carefully, intelligence shouldn't be centralized, it should belong to the individual, not the institution. On the surface, that sounds like a noble, democratizing mission, a classic underdog story pitting the decentralized ethos of crypto against the Goliaths of centralized AI like Google and OpenAI. It's a sentiment that gets cheers at tech conferences. But when you understand the intricate web of finance, data, and artificial intelligence that now governs our world, this statement is not a vision, it's a 5-alarm fire for the global financial system. It is a direct and public admission from one of the most powerful, yet opaque, figures in finance that the current centralized model of AI is not just flawed, but is a fundamentally unstable, ticking time bomb. And Tether, the company that literally creates and controls the digital lifeblood of the crypto markets, over $100 billion of the USDT stablecoin, is so convinced of this impending collapse that they are publicly building the lifeboats. Think about that for a moment. The entity that serves as the primary dollar-denominated plumbing for virtually every crypto trade, the foundational layer upon which billions in speculative value are built every single day, is now signaling that the entire structure supporting the next technological revolution is unsound. This isn't a random tech startup CEO sharing his thoughts. This is the equivalent of the captain of the Titanic, after hitting the iceberg, calmly announcing he's investing in submarine technology. The warning is not in the words themselves, but in the terrifying context behind them. Centralized AI, the kind being built by the tech titans, is insatiable. It doesn't run on hopes and dreams. It runs on two things: unimaginably vast amounts of data and catastrophic amounts of computational power, which translates directly into astronomical, continuous, and non-negotiable costs. These AI models need to be trained, and that training process burns through hundreds of millions of dollars in electricity, cloud computing contracts, and hardware. Where is that money coming from? Venture capital is a finite resource, so these companies are turning their AI models into revenue-generating products at a frantic pace. But here's the catch: 22 to generate revenue, they need to be integrated into the core functions of the global economy: lending, risk assessment, trading, and market analysis. This means the financial health of the biggest banks, hedge funds, and tech companies is becoming inextricably linked to the performance and stability of a handful of incredibly expensive, complex, and energy-hungry AI systems. They are becoming, as Ardoino implicitly warned, a single point of failure, and this is where the fuse is lit. Imagine a scenario, not in a distant future, but in 2026, where a critical flaw is discovered in a major foundational AI model used by several of the world's largest investment firms. Perhaps it's a vulnerability to a specific type of data poisoning, or a latent bias that causes it to make catastrophic errors in high-frequency trading during a period of market volatility. The discovery of this flaw triggers a cascade of automated selling, a digital bank run executed not by humans, but by other AIs responding to the same flawed data. Liquidity evaporates in seconds, and in this moment of peak digital panic, where does everyone flee? To the safety of the US dollar. But in the crypto markets, the gateway to that dollar is overwhelmingly through one door: Tether. The demand for USDT to cash out would become a tsunami, a stress test beyond anything ever conceived. This is the silent warning. Tether knows that the coming AI-driven financial panic will place a demand shock on their reserves that could break the system. They are telling you, in their own cryptic way, that the house of cards built by centralized AI is so fragile that its collapse will inevitably wash back into the foundational layers of crypto itself. And they are positioning themselves not as the cause, but as the only entity that saw it coming and tried to build an escape route. The crash won't start with a Lehman Brothers bankruptcy filing. It will start with a cascading AI failure that triggers a liquidity crisis, exposing the fatal interdependency between our speculative AI future and the digital dollar that fuels it. This is the prediction, and the first domino has already been tipped. So, how does a flaw in an AI model translate into a global financial catastrophe? To understand that, you need to see the invisible cage we're building for ourselves. Centralized AI isn't just a tool, it's becoming the central nervous system of the entire financial world. And right now, that nervous system is being wired with a critical design flaw, a homogeneous intelligence. Think about it. The world's major financial institutions aren't all building their own unique, proprietary AI brains from scratch. The cost is too high, the talent too scarce. Instead, they are licensing, fine-tuning, and building upon a very small handful of foundational models, the GPTs and their equivalents of the world. This creates a dangerous consensus reality. When 10 major hedge funds, 5 global banks, and 3 rating agencies are all using intelligence derived from the same core model, they stop being independent actors. They become a single, massive herd, all reacting to the same stimuli in the same predictable way. This is the single point of failure I mentioned, and it's far more dangerous than a bank collapse. A bank can be bailed out, its assets sold off. But how do you bail out a corrupted consensus reality? How do you halt a trading panic when the panic is being executed with cold, robotic logic by the very systems designed to ensure stability? The trigger could be anything: a geopolitical event that the AI interprets in a way no human would, a piece of corrupted data injected into its training set by a malicious actor, or simply a black box error, a glitch in its complex reasoning that its creators cannot foresee or explain. The AI, tasked with maximizing profit and minimizing risk, will execute its programmed response with flawless, terrifying speed. It will start liquidating positions to cover potential losses. But because every other major firm is operating with the same foundational intelligence, their AIs will detect this selling pressure and interpret it as a confirmed market signal, not a glitch. They will then trigger their own automated sell-offs to protect their assets. This creates a self-reinforcing feedback loop of pure, unthinking panic. Billions of dollars in assets could be liquidated in minutes, not by a human decision, but by a cascade of automated responses to a single, flawed data point. This is the flash crash of 2010 on steroids, but this time there will be no human circuit breaker fast enough to stop it. The velocity of this collapse will be measured in microseconds, not minutes. And this is where the Tether Warning becomes terrifyingly specific. As this AI-driven liquidation storm erupts in traditional markets, a massive flight to safety will begin. Investors will scramble for cash for the US dollar. In the crypto ecosystem, the primary on-ramp and off-ramp for that dollar is the stablecoin market, and Tether's USDT is the undisputed king. The system will face a demand shock of historic proportions. Every investor, from the whale to the retail trader, will be trying to convert their USDT into actual dollars at the same exact moment. This is the digital equivalent of a bank run. Tether's stability is predicated on its ability to honor a one-to-one redemption. But its reserves, while claimed to be backed by secure assets, are not a stack of cash in a vault. They are a complex mixture of treasury bills, corporate debt, and other instruments. The integrity of the entire system rests on confidence. In a moment of peak, AI-generated panic, that confidence will evaporate. If doubts emerge about Tether's ability to process every redemption request at full value, a death spiral begins. The price of USDT would depeg, dropping to 99 cents, then 98, then 95. This wouldn't just wipe out crypto wealth, it would shatter the primary liquidity mechanism for the entire digital asset space. Exchanges would freeze withdrawals, trading pairs would break, and the liquidity that the AI-driven sell-off sought in the first place would vanish completely. The crash would leap from the screens of Wall Street traders to the portfolios of every crypto holder on the planet. The centralized AI, in its flawed attempt to protect its assigned portfolio, would have inadvertently triggered a collapse that wiped out the very ecosystem that supports its own digital fuel. Tether's CEO isn't warning about a crypto problem. He's warning about an AI problem that is destined to become a crypto problem. He is stating in corporate language that the centralized AI giants are building a rickety skyscraper on top of a foundation they do not control and do not understand. And when their skyscraper sways in the wind, it will be Tether's foundation that bears the catastrophic load. The silent warning is that the contagion is already programmed in. The lines of code that will execute the crash are already written, currently being tested and refined in data centers around the world. We are not waiting for a trigger to be pulled. We are waiting for the automated sequence to begin. Now, you might be thinking this is just a problem for the Wall Street elite and crypto whales, that your small portfolio is safe in the storm. That line of thinking is the very reason this crash will be so democratically devastating. The tentacles of centralized AI have already wrapped themselves around every facet of your financial life, and you likely don't even realize it. This isn't just about hedge funds. This is about your bank, your retirement fund, your mortgage lender, and even the apps on your phone that manage your micro investments. The algorithms that determine your credit score, approve your car loan, and manage the index funds in your 41 type are increasingly powered by the same homogeneous AI intelligence we just discussed. When the cascade begins, it will not discriminate. The initial AI-driven liquidation in the high-frequency trading sphere will create a massive shockwave that ripples down through every layer of the economy. As asset values plummet to balance the automated selling, the paper value of your retirement account will nosedive. But the damage won't stop there. The AI systems managing your pension fund, spooked by the market volatility and the sudden deep peg of a major stablecoin like USDT, will automatically shift to a more conservative stance, freezing withdrawals or halting trading to protect the fund's assets, effectively locking you out of your own money at the very moment you might need it most. This is the true nature of the single point of failure. It creates a system-wide seizure. The same centralized AI that was touted as a tool for unparalleled efficiency becomes the instrument of total paralysis. And in the chaos, the very data that these AIs rely on will become corrupted. Imagine the AI models that are tasked with valuing companies. In a stable market, they analyze earnings reports, market trends, and news sentiment. But in the panic of 2026, the news sentiment will be overwhelmingly negative, a feedback loop of fear generated by the crash itself. The AI, with no human capacity for context or gut feeling, it will take this data at face value and begin a vicious cycle of devaluing assets based on the panic it helped create. A company with strong fundamentals could see its stock price annihilated because the AI interprets the market's emotional turmoil as a fundamental data point. This is the AI death spiral, where the machine's cold analysis of a crisis actually makes that crisis worse, creating a new, terrifying form of financial reality where perception, amplified by artificial intelligence, becomes a destructive economic force. This is the silent warning from the Tether CEO that 99% missed. He isn't just worried about a bank run on his company, he's warning about the complete breakdown of the data integrity that the entire modern financial system is being built upon. When he says intelligence should be decentralized, he is arguing for a system where millions of individual, independent AIs compete and collaborate, creating a resilient and diverse ecosystem of thought, much like a healthy free market. The current path of centralized AI leads to a digital monoculture, and in nature, a monoculture is incredibly productive until a single blight wipes out the entire crop. The AI financial crash of 2026 is that blight. Tether's new initiatives, their push into decentralized AI infrastructure, is their attempt to create a vaccine, to build an alternative, resilient network before the blight hits. They see the future where the centralized AI models, in their desperate hunger for data and profit, become so entangled with the global financial system that their failure is not an option, it is a certainty. And when that failure comes, the demand for a safe, dollar-pegged asset will be so immense it will threaten to rupture the very foundations of the crypto economy they helped build. They are not predicting this crash out of clairvoyance. They are forecasting it based on the observable, reckless architecture being put in place today by the centralized AI giants and the financial institutions that are becoming addicted to their power. The crash is not a matter of if, but when, because the incentives are perfectly aligned for it. The AI is incentivized to be fast, not prudent. The corporations are incentivized to be efficient, not resilient, and the investors are incentivized to chase yield, not to question the stability of the intelligence guiding their decisions. We are building a skyscraper of unprecedented complexity on a foundation of sand, and the Tether CEO is the one who has seen the seismograph reading that everyone else is ignoring. The tremor is already registered. The quake is coming. So where does this leave us? Is this a doomsday prophecy we must simply accept, a foretold financial apocalypse where we are powerless pawns? Absolutely not. The entire purpose of this prediction, the reason for sounding this alarm now, is to provide you with the one thing the centralized AI system cannot: context, foresight, and a clear, actionable path to not just survive, but to thrive in the chaos that is coming. The coming crash is not the end of the story, it is the violent, necessary transition from a fragile, centralized system to a resilient, decentralized future. Understanding this transition is your ultimate advantage. The first and most critical step is to recognize that the old paradigms of safe investing are now obsolete. The traditional 60-40 portfolio of stocks and bonds will offer no protection when the AI managing the bond fund and the AI executing the stock trades are both failing in unison. Your strategy must evolve from one based on asset classes to one based on system architecture. You need to begin moving your value and your trust away from the centralized points of failure and toward the decentralized alternatives that are being built right now. This isn't just about buying Bitcoin as a hedge, though that is a piece of the puzzle. This is about actively seeking out and supporting the ecosystem of decentralized finance, or DeFi, that operates on open source code, transparent ledgers, and without a central intermediary that can freeze your assets. It's about exploring the emerging world of decentralized AI, where models run on distributed networks, no single company controls the intelligence, and the entire system is inherently more robust against a single point of catastrophic failure. This is the future that Tether CEO is alluding to, and it is the lifeboat you need to be building for yourself today. But this is more than a financial shift, it is an intellectual one. You must become fiercely critical of the black boxes that are increasingly managing your life. Question the algorithms. Demand transparency from your financial institutions about what tools they are using. Stop blindly trusting the recommendations of AI-powered apps. Your greatest weapon in the age of artificial intelligence is your own human, critical thinking. The crash of 2026 will be a brutal audit of every system and every individual. Those who audited their own exposure first, who understood the interconnected risks, will be the ones who emerge on the other side, not just with their wealth intact, but positioned to capture the generational opportunities that arise from the ashes of the old system. The rebuilding phase will be the greatest wealth transfer of our lifetimes, and it will flow toward those who built the new decentralized infrastructure and those who had the foresight to place their capital within it. This is your call to action. This is not a video you simply watch and forget. This is a blueprint for your financial survival and prosperity. I am giving you a 2-year head start. Start now. Begin by diversifying not just across assets, but across technological paradigms. Allocate a portion of your portfolio to truly decentralized networks. Educate yourself on how to self-custody your digital assets so you are never again at the mercy of an exchange that can halt withdrawals. Research the projects building decentralized computation and AI. Support the developers who are coding a more resilient future. This is the single most important thing you can do. The countdown has begun. The warning has been issued. The choice is now yours. You can dismiss this as a speculative theory and remain comfortably invested in the old system as it methodically prepares its own collapse, or you can heed the warning and take proactive steps to become anti-fragile. You can be one of the 99% who are caught by surprise, scrambling in the panic, watching your financial security evaporate in a cascade of automated decisions, or you can be part of the 1% who saw the matrix, who understood the code, and who positioned themselves for the inevitable reset. This is more than an investment strategy. It is a declaration of intellectual independence from the centralized systems that have failed us. The future of intelligence is decentralized. The future of finance is decentralized. The question is, will your portfolio be? The time for passive observation is over. The time for deliberate, informed action is now. Go to the description below this video. I have left a critical link to a free, comprehensive guide I've created called The Decentralization Survival Blueprint. It breaks down the exact steps, the specific assets, and the foundational principles you need to understand to navigate the next 2 years. It is your first, most crucial step. Download it, study it. Your future self will thank you for the head start. The crash is coming, but your financial future does not have to be a victim of it. Seize this information, take action today, and let's build a decentralized future together.